Hello and welcome to IUL with Jarrell. Today we're going to be talking about how does your money actually grow in an IUL? Well, to start off, we got to understand the basic functions and how options work. So to further explain this, let's say that you have $100,000 house that you want to sell and I want to buy it, but I don't want to buy it this year. I want to buy it next year. So you can sell me that option to purchase this house for $5,000. So what this means is, let's say the house goes up in value and it's now worth $120,000. Well, you contractually have to sell it to me for $100,000 because we entered that options contract. So now you get to keep the $5,000. So your true opportunity cost would be $15,000. However, let's say the opposite happens. The house goes down to $80,000. Do you think that I'm going to buy the house for 100 grand when it's only worth 80? No, of course not. So in this case, you would pocket the $5,000. And that's how options work in a basic nutshell. So how does it work within an insurance contract? Well, insurance companies are really good at making money. So they're going to have a fixed rate of anywhere between 3 to 5%, depending on the carrier. Let's say it's 3%. What this means, this is their fixed rate. So if you're in the fixed rate, you get 3% no matter what happens to the market. The market goes up 10%, you get 3. If the market drops down 10%, you still get 3. So they're going to credit you that $3,000 again, no matter what happens. What they allow you to do is they say, hey, if you don't want to take the 3,000, you want to use it as an options budget, that's perfectly fine. We'll take that 3 grand, we'll come over here and we'll give you the options budget. Let's say that options budget gives you a 10% cap. Now, if the market does 10% or better, they're actually going to credit you $10,000 instead of 3. But let's say the opposite happens and the market crashes 10%. We really can't lose any money. All we'd lose is the fixed rate that they were going to give us anyways. So therefore, our principal would still be protected at that $100,000. Now, you can elect to stick with the fixed rate or you can choose the options. For example, if we get 10% one year and we get 0% the next, we're now averaging 5%. But if we get 10% one year and we have a good inclination the market's going to be a negative year the next year, you can say, hey, I just want to take the fixed rate and get my 3%. Now you're averaging 6.5%. Well, one is going to underperform the illustration and one is going to outperform the illustration. So you definitely want to take a look at your options each year. Now, there's other options as well. There's one that very few companies have, but it is awesome when they do. It's called the uncapped S&P option. What this means is there is no cap. So you can have unlimited potential returns. The way this one works is they hold what's referred to as a spread. In this case, we're going to use 10%. So the market was to do 30, they're going to take their 10, you're left with 20. However, if the market was to do 15, they subtract their 10, you would only get 5. We would have been better off to stick with the standard S&P cap where we would have got 10%. Now, the market does 5 and they subtract 10. Normal math tells us that would be negative 5%. But again, the way the options budget works, we cannot lose. So zero's the hero. Where does this strategy typically make sense? Well, normally it makes sense after a crash. Whenever we have a major crash, traditionally there's a nice recovery. For example, if we take March 2020, the market crashed 60% almost overnight. That year you would have received 0% because remember, zero's the hero. However, the following year, good old USA decided to inject a bunch of money in and cause all the hyperinflation we're receiving today. The market went back up 66%. Now, did it actually go up 66? No, it just recovered. So at that time, that spread was only 5%. So you would have got 66 minus 5. You would have received 61% during this period. Now, this is not some fabricated, made up number. As you can see here, this is an actual statement from an actual client. This matured segment was as of 3/15/2021. He was in that 1 year no cap indexed account. As you can see, the cash value was worth $872,786.85. After cost of insurance and fees, that segmented index was $852,105.77. This client earned 61.33%. He was credited $535,313.34 to his account. And now he has access up to $1,387,419.11. Now, am I saying this is going to happen to you? Probably not. The stars, the moon, everything aligned for this client, but it does show a lot of the upside potential on how these policies work. So it is important to make sure that you're taking a look at your crediting allocations each year. Now, if you're the type of person that doesn't want to have to do that, you can always just set it and forget it. Stick with the S&P. You're probably going to average right around the 6 to 8%, which is more traditional. So now that you understand how the cash actually grows in these policies, go ahead and leave a like and subscribe for more future videos just like this, where we go more in depth on these type of policies.